Petite Poison PR. Hi, good evening. People support. Hi. Quite an influx today. Yusufa, hi. Niskomania, hi. D1, hi. Sarawasai, Abdul, and Miss Star. Hi, welcome. TP. Good evening. We start in about 3 minutes. Freddie's in the house. Freddie's such a stingy person. Freddie, what are my signals? You brought this upon yourself. Hey, Miss Star. Hi, TP. How you doing? Lyrical One, welcome. Abdul, good evening. TP, I'm doing good. Thank you. Freddie, you don't enter. I want to transfer you don't enter like this. My palm is scratching me right now, look. That tells me you're going to give me signals. Make you don't go by me. Yesterday was kind of taking my sleep during the session. No wahala. Anytime you sleep off or whatever, go to my YouTube. Okay. When I already ask, am I Nigerian? I am very Nigerian. So let me explain this again. I have a pinned video on my profile explaining this. Depending on the audience I am speaking to, and this is not on purpose, it's been my whole life, my accent will change. If I'm speaking to an Aboki now, he'll probably be arguing with me that I'm not from the north. Because I have a northern accent when I'm speaking to him, and that's not because I know how to speak Hausa. I can't speak a lick of Hausa. If I'm speaking to my Omanna brother in Aba, I will be sounding like an Abagia. If I'm talking to someone with Yoruba accent, same thing. So it's always been a thing my entire life. But when I am addressing an entire group of people that I know will probably have, how am I going to put it? Basically, a broad range, then this is just my natural way of speaking. And also sometimes it depends on what TV show I've been watching. So if I've been watching something with a British accent, what's that show again? What's that show? One with the lovely outfits. Whatever, you get the point. So I am very Nigerian. All this to say. Abi your sister or TP. My YouTube channel is I Take Ticks. It's also I Take Ticks. So that's youtube.com/I Take Ticks. ITAKE Ticks. TICKS. Ready? It is 11. Big Baby, thank you for sharing the live. Nelo, thank you so much. Tindeep, thank you so much. Let's see what I missed here before I proceed. TP, I'm glad that you're doing good. Hey, D1. How you doing? Let's see what I missed before I get into it. GNF, thank you for the follow. All right. Freddie, if I don't get a signal from you this night, you're banned. Everywhere. Plus your alts. Your alt accounts. All of them. Banned. Patty, hi. I see you. Good evening. All right. Just going to run through the roster once more. Ma agreed to now. You know, be say Snesh. Yo. Snesh. I'm going to pronounce it that way. My bad. Welcome to the live. Down 8, welcome GNF. EAA Eric, you're welcome. Bernard Gatonga, you are welcome. Big Baby, hey. Tariq 69, welcome. Sarah Osai, how you doing? Yusufa, how you doing? Lyrical One, I already said hi, but hi again. M Tob Zar, how you doing? Abed Autotech, Tindeep, TP, Mistar, Patty, Nalo, D1, and of course, my signal over Freddie Black. Hi, Patty. All right, that's enough. Let's turn around and let's get this party started. Boom. Let's make that. Hell no. Please, reduce. Oh, God damn it. You will not fall off my dining table. Balance, my friend. Okay, let me forget to put this one here. No vex, people. Give me a while. Let me set up. Good evening, good evening, good evening, good evening, good morning, good afternoon, good whatever time it is, wherever you are. I hope you guys are having a wonderful time. I hope you had a wonderful trading session. I hope things were simpler for you based on yesterday's teaching. And I'm hoping that today I can make things even simpler. Right? It's all going to be the same thing we keep talking about. Give me a sec. I just know the charge. One for my hand this evening. Not lie. Who did this bit? Yar. Okay, let's get started. So, you know what it is I always teach about, those of you who are familiar with me. You know I always talk about liquidity. You know I always tell you that I don't need you to change your strategy. That if you are using, even if it's just a moving average cross, by adding what it is that I've been sharing with you, you will have better entries, better exits, and you won't have to wait until your stop loss is taken before you know to get out of a trade. Okay? So it is my desire today to simplify things for you as usual. So let's get started. You already know the story I'm about to tell, and it's the story of price, which is liquidity. As you already know, I do not claim that I created this concept myself. What I did do was find a way to simplify it, to make it stupid simple, because I found that in my 10 years of trading and 9 years of those were losing years, blown accounts, lots of money lost, lots of sleepless nights, lots of depression, etc. You know, all that fun stuff. I found that the problem that I had was that things were just too much. It was too much. I knew too damned much. And so when I open a chart, I'm seeing reasons to buy and sell, reasons to close my buy, close my sell. It was crazy. I don't need that shit. So I promised myself, I said, Nessa, when you figure this out, you're going to share this. You're going to do your best to share it. I don't think that me sharing this is going to be that significant that the markets suddenly change. I don't think so, because every day there's new people coming into trading that don't understand how it works. And there's also people who do things the way they want to do things. Basically, there will always be the market. So you don't have to worry that there's something that's going to change. Someone was in my DMs asking me about liquidity sweeps. When I am talking about liquidity, I talk about it the way I talk about it on purpose. It is to keep things simple. I don't think I've said anything about liquidity sweeps. Technically, I have. If you listen to everything I say, I have been telling you what it is. I have been. So let's say this rectangle here is representing price, a range of price. If the price has been trading within this area here, and then suddenly, I'm going to request. Stop sending me requests to co-hosts. If you're in here, I don't know how that works, how I can turn that off. I wish I could. I don't get that option until people have tried thrice. Please quit it. So as I was saying, if the price has been trading inside of this box, let me make it smaller so you can see. It's been trading inside of this box and then suddenly it pops out of here. And then you're looking, if it's popping out, that's it grabbing liquidity there. You want to call it liquidity sweep, liquidity, what, it doesn't matter. The point is that it's grabbing liquidity. If there is an internal range liquidity inside of here and the market taps into it, it's still grabbing liquidity. Is touching it, is grabbing it, is picking it up, whatever term you want to use. Don't get confused or carried away by these specific terms. Don't get carried away by these things. Focus instead on the story. I keep saying story for a reason. Think about it. When you and we go to the movies and we watch a particular story, we may not tell the story. If somebody says, okay, come and tell me what happened in this movie, we may not tell it scene by scene by scene, but we understand exactly what happened in the story. We know who got to kiss the girl. We know who died. We know whatever happened, who blew up what. So think of it as a story. And the story is very simple. We're going to get into it now. So first things first, I have always said that your job as a trader, after you've figured out what the trend is, and let's quickly touch on the trend just for those who are kind of new to trading, new-ish, because I have some of you here who I appreciate you. You're actually new and yet you are still putting in the work to try to understand what I'm saying, even if you've never heard of it before. And for you, I will do this. So your first thing, whatever you do, is you come to the chart and you must figure out the trend. For those of you who are using Japanese candlesticks, pay attention because it'll be harder, sort of. The thing about prices, it never goes straight up and it never goes straight down. It has to make these pushes. It's like breathing. Breathe in, breathe out, breathe in, breathe out, okay? So when it comes to an uptrend, this is my opinion, right? The market has two basic states. It's either pushing up or it's pushing down. I don't believe in the concept of consolidation per se, even if you see me highlight it here and there. The reason I say that is even in that consolidation, if you zoom into a low enough time frame, you will see the market is still doing what? Pushing up and pushing down. Always. Why? Because the market is fractal. Okay? So let me show you this. When you're in an uptrend, you have this low, you have this high. Then you have a higher low that is created. How do you know the higher low is created? Because the market starts to push away from that area and breaks this high. Once it breaks this high, you have a higher high, and then a higher low, higher high, etc. And it keeps going like that. So sometimes in an uptrend, basically most of the time, and I want you to keep this in mind, okay? Anything I'm teaching you about price, anything I'm teaching you about trading, understand it is the business of probability. What does probability mean? It could happen, it could not happen. So what I'm showing you is stuff that happens more often than not for you to exploit. Do not come to me saying I taught you or claimed that this is a holy grail and then you took it and you made that one trade or just those 5 trades and you lost. That's not how this works. Okay? So in an uptrend, you will notice that the highs keep getting broken. Okay, this push here breaks that high. This push here breaks that high. And the lows are typically respected. But sometimes the market will pull some funny shit like this. It'll push up, you have that higher low and higher high, and then it does some fuck shit by breaking this place here. And you're like, oh, maybe it's about time that I start selling. But then what? Then what does it do? It goes up and says, psych, nah, we're still bullish, bitch. Now I have your money. Why does it do that? Because typically, now this is a story. This is the story. Pay attention to the story. If you listen to the elements of the story, it'll help you with your trading. It does that because, hang on a second, let me stretch this out. It does that because in your textbooks, you've been taught, by your gurus, you've been taught that whenever you have a low and then the market starts to push up, go in for a buy, have your stop loss at the low. Go in for a buy, have your stop loss at the low. So what's happening? Whenever you notice actually that the market is doing this consistently, there's a term for it. I don't like to bring it up, but there you go. It's called engineering liquidity. And what does liquidity mean? Liquidity actually just means money. It's a fancy fucking word for money. It's just money. Why is it money? Because there are stop losses here, there are stops here, there are stops here. And everything that happens on the chart is all about moving money from one place to another and gathering enough money to actually make some more money, if that makes sense. The reason that you and I have access to these charts is not because someone at the central bank or someone at the World Bank or IMF gives a damn about us. They don't care. The reason they make this so accessible is because a lot of us, we come into this, we're utterly clueless. And so we do the things that are general knowledge without realizing we're being set up. So when you have this and it looks really great, then what? Then what? Then what happens? Then you get this crap here. What happens when you have this crap here is basically you're being fooled into thinking because, let's say those of you who have learned about breakout trading, you're looking at this low and it's like, oh, this is broken. Sell, 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 sell. So now you're selling. And what did they teach you? Put your stop loss at the most recent high, right? So you've sold and now your stop is here. And then the people who bought here and have their stops here, they're having their stops taken. And then you're happy because the market's going your way for a little bit, but then whoop, there you go. It pushes back up. And now it's taking your stop as well as a seller. And this is usually the point where you start getting psychologically confused because, oh my God, what is happening? What's going on? I tried to buy, they took me out. I tried to sell, they took me out. And now you feel unsure and uncertain. That is by design. Typically, this is where you start doing dumb shit or you feel so afraid that you don't want to open up your charts anymore and continue trading. So this is what an uptrend typically looks like. Now, how do you know when it's becoming a downtrend? Or how can you tell? Well, again, like I said, you cannot assume that everything plays out 100% of the time. Whatever you're being taught, whether it's from me or someone else, if they're actually a good teacher, they'll let you know that what they're teaching you is not something that's going to play out every time, but it plays out enough times for you to exploit it. And that's what matters. So in this case, what do you have here? You have this low. Let me bring this down. You have this low over here. Then the market pushes down like this, breaking it. But you're not going to fall for that because you want to wait and see. You need confirmation, right? So what does the market do this time around? It pushes back up. It pushes back up and then starts to push back down, breaking this low. And is at this point you can confidently say to yourself, aha, it looks like we have gone from a bullish trend to a bearish trend. And in a bearish trend, what you'll notice is that the highs are always being respected, meaning the market does not trade through them. Let me stretch this out a little bit so you can see what I'm talking about. Hang on a sec. So the highs are typically respected. Look at this. The market trades up into, it pulls back up into here, pushes down, pulls back, pushes down. Also, you notice that the pullbacks are not as deep as the pushes to the downside. Same thing for the uptrend, okay? So the highs are being respected, but sometimes they will do the same rubbish when it's the downside as well. So you have this high and this high gets disrespected. And it's like, oh my God, let's buy. This is a breakout, guys. Oh, we're screwed. Those of us who are selling, we're screwed now because we got our stops taken. So let's buy. Let's buy. And where's our stop loss going to be? We'll put it at this swing here. And then they do that shit again. Boom. Now they've taken your stop losses as well. And they're taking all of that money and pushing it down to the bottom. That is basically how it works. If you are paying attention, the reason I keep saying story is quite literally, I have given you a strategy just now. But those of you who are not paying attention, you probably missed it. Let me repeat myself. If you know that you are in an established, I'll say it plainly now. If you know you're in an established downtrend, and I've told you how to recognize one, guess what? You know what you could do? Let me go back all the way up here and change this color. Give me a second. I will show you what I'm about to show you now. And make that a little bit lighter for the people to see. Great. You know what you could do? If you wanted to, and it does mean that you will be missing out on moves, no problem, but it also means that the chances are high that when you get a move, it'll be a good move. So look at this. You could very simply, once you've established that, oh, this is a downtrend with this lower high here, we're just waiting for the market to take this place. Oh, it doesn't. It pushed down and it pulled back up. All right. And now it's pushing down again. All right. Now I'm just going to wait for you to take this high. Oh, it didn't, and it went down, and it pulled back up again. Okay, fine, no problem. I'm just going to wait for you to take this high now that you're pushing down. Oh, wait a minute. What are the odds? What are the odds that maybe this is not an actual break? Okay, maybe what I will do now, let's say this is a 4-hour time frame or a 1-hour time frame, I'm going to go down to a 15-minute or a 5-minute, and I'm going to wait for whatever my entry criteria is. Those of you who use moving averages, whatever it is you use, break and market structure, I don't care. You're looking basically for the sign that says, this is your signal to sell. And then what are you doing? You're taking that liquidity from outside of here, the money that's resting outside of here. You're joining the big boys and the banks and the big players that run the markets here. And while everybody's trying to buy, you're trying to be a seller. Does this mean it'll work all the time? Absolutely not. Not all the time. But when it does work, holy shit, it does work. And that's all you need. Same thing for buys. Okay? You're waiting for this low to get taken. It doesn't. This doesn't. This doesn't. This. Finally, you have this guy here. You set an alert. You've been setting alerts the whole time, watching the market. And then your alert hits around here. And now you're watching. You're waiting for signs of that turn. And then you get the sign that the market's ready to turn around. However you choose to get the signs up to you. And then you're in it. And then you already have a great target here. Why? This is what you'd be targeting at least. If not beyond, at the very least, this. So I'm sure that makes sense. Please understand why I keep saying story. I call it a story for a reason. All right? Even here, if this had happened, this is a low, that gets taken. You might have interpreted this as, oh, okay, this is an opportunity for me to buy, and it would have worked out for a little bit, but then it turns around. It does not matter. It's okay, because ultimately there will be times when it will work out. And if you're not being greedy, if you're not risking too much, if you're being sensible about your risk, sensible about your lot sizes, then you'd be good. This wouldn't matter because eventually the market will present you with an opportunity. So let's go back to what I was going to teach today. And I keep saying it's all about, now that you understand the trend, you have 3 questions that you must ask yourself as a trader. Number 1, this is your job as a trader. As soon as you open up the charts, first thing in the morning, afternoon, whatever time it is you trade. Okay, number 1, where is the money coming from? Number 2, where is the money going to? Number 3, is there enough room between these 2 places for me to take some for myself. These are the 3 questions. Hang on, let me change this color. All right, much better. Mejor. These are the 3 questions you're asking yourself. If you don't have the answers to these 3 questions, you do not trade. And I have talked about multiple ways of defining a range, defining this, all of this, these answers. The answers to these questions, they lie in, I'm going to have to pick something that makes more sense. Go back to that red. The answers to all of these questions lie in something called a range. Think about what a range means. First of all, my personal definition of a range, I don't care what you've heard, but it is simply this: the area between 2 price points. So, with my trusty little horizontal line here, this area, from this top to the bottom or bottom to top, that is your range. That's the area. Do you know you could literally plant 2 lines randomly on the chart and say, yeah, that's my range, and I'm going to wait and see what the market does at specific levels of the range so I can actually take some action. That's one way. If you want to keep your life simple, you could say, I'm going to define my ranges by using, I'm going to drop lines every 50 pips. So let's say the price action is around here. I'm going to set a line that's 50 pips away from it, 50 pips here, and then 50 pips below it, because I want to see what happens in all of that. You could do it that simply. For those of you who are stressed out, another way you could do it very simply. So let me start mentioning the different ways you can point out what a range is. So 2 random lines. You can do this, yes, but I don't recommend that you do it without structure. If you're going to do this, use round figures. What I mean by round figures, so if the price is currently at 2.03400, then or 2.03500, then you use 2.04, if you understand what I'm trying to say. So basically, let's say zeros and 50s. That's one way you could do it. Another thing I remember ICT teaching was 20s and 80s, but I don't use those. But that's up to you if you want to. That's fine. Okay? It could be 2 random lines. I haven't said that before, per se, as clearly as I have now. But let's see. I need to bring this down so you guys can see this. My bad, sorry. Also, I need to position this better. Give me a moment. Give me a moment, guys. I need to make sure you're actually seeing this shit properly. Balance, balance, balance. All right, much better. Much, much better. Muy mejor. So, 2 random lines. That's one option. Option number 2. We can use any candlestick. What do I mean by this? Literally, I'm going to come back to the idea of a range. If it's the difference between 2 price points, I don't care if that difference is only 1 pip. If it's only 1 pip between these lines, heck, if it's 0.2, if it's just 2 points, not 2 pips, that's still a range. Think about the definition of the word range. When you say you have a range of something, it means that same thing, just in different iterations, in different makes. Like it's like a range of Range Rovers, for example, a range of Lambos, and you go by year, the 2025, 2024, and whatever. It's the same thing with price. So literally, that means you get to define the range however the fuck you want to. So example number 2, I said, is any candlestick. Now let me take you to an actual chart. What you're looking at right now is the 4-hour chart on GBP AUD, okay? Which means that each of these bars here is worth 4 hours of price action. Which means you have, per candlestick, more often than not, apart from people like this guy, which didn't have a high. The high is the same thing as the open in this case, but typically you have 4 price points per candlestick. If you're using a Japanese candlestick, you have the open, you have the high, you have the low, you have the close. In this case, over here, you have the open, you have the high, you have the low, you have the close. Okay? All the time. So you could, if you wanted to, pick this as a range. This is random. There's no, I haven't given you better ways of structuring this, but just hold on a second. Let me change this and change the color to something that's easier to see. White and then lighter. Let's bring this down a little bit. And also I need to brighten my screen so I know what you're seeing. Beautiful. So this is a range. And notice what I was talking about at the start of this live, for those of you who started on time. What do we have here? You people are looking for the word sweep. I don't use sweep. It's not that deep. It's basically the market popped out of here. We go to a lower time frame. We look for reasons that we want to be a seller around here or maybe just around here. And then it turns around. And what have we said about basically boxes? If we're taking out the high first, we want to go to the low. And if we're taking out the low first, we want to take out the high probably, or at least 50%. But let's not get ahead of ourselves. And there's something else that I want to say. I don't think I've explained it before multiple times, but I'm going to explain it differently. Let me come back here, okay? Back to this matter of trends. I need you to understand that, let's say this is a 4-hour chart, and I'll show you an actual example. Let's say this is a 4-hour chart. This move here, all of this, everything you're seeing, this is a 4-hour chart. It is possible that this push to the upside that looks pretty much straightforward, when you highlight that and you go to a lower time frame, you will notice mini ranges, or rather, what am I saying? Mini trends inside of there. You will notice even possible reversals for that particular time frame. So let's come back to Pound Aussie. Let me show you an example. Let's take a look at, let's see. Let's take a look at this retracement leg here. It's a 4-hour chart, so it's pretty significant, and it's also the Pound Aussie, which typically gives a lot of pips. As you can see, this retracement in its entirety is 137 approximately, right? So I've highlighted this, and what I'm going to do now is, actually, I want to focus on these 3 candles that pushed down. And then we can go to like a 5-minute time frame. And what you're seeing here, this is our 5-minute. Notice how on the 4-hour chart, you had that straight push down. This is the 5-minute here. What do you have? It's not a straight push. It's literally giving you a downtrend. This is, let me zoom in here so you can see it better. Do you see that? It's giving you a downtrend in what looked like, oh, it was just a straightforward thing. Okay? Why is this important? Why does it matter? Because the market is fractal. Why I keep saying that is, if you are on the H4 and you want to trade a single bar as your range, you can. Because there's stuff going on, it looks from here as if you can't. But if you drop to a low time frame, you'll find there's stuff going on. Let's look at this. And let's go, now that you understand basically what a trend is, and I've given you kind of a strategy of sorts. This is that area here on the 5-minute chart. This is that moment that H4 high, why does this keep moving? This H4 high got violated. Or for those of you that insist, you want to say sweep, say sweep. That's up to you. You want to say grab, say grab. You want to say chuked, say chuked. The liquidity was chuked. Don't stress me. Whatever, okay? So here you are. This is high. And then what? What happens? You have a low, the market breaks it, and then pulls back up, and then breaks it. And now you're sure, okay, it's actually wanting to turn around. It could be that simple. It could be that simple. Minus everything else I'm going to show you tonight, it can be this simple. Literally, grab a bar, any bar, and then wait to look for whether the market's going to break back in or break out, whatever. Okay, so let me come back here. Where was I? H4. Yeah. We're talking about how to define your ranges. I've shown you how to do that with a Japanese candlestick. And I've shown you that the H4 candle can have a lot of activity on a lower time frame. And the same thing goes if you're looking at a monthly chart, you scale down to a weekly, etc. It starts to give you more and more. A single candlestick has more information within it, if that makes sense. So you can define a range with a single candlestick. That's a Japanese candlestick. Let me take you to a range bar chart. My absolute favorite. Well, one of my favorites. So this is going to take its time to populate. Why? Because it is not your regular price chart. It is based on, it's not your regular time frame chart. It doesn't use time, it uses price, which means that it doesn't matter. I need this to load already. Okay, there we go. Which means it does not matter if it takes 10 years. So this is a range bar chart, and it's called a range literally because it is based on ranges. So this one is set to 50 pips. This chart is a 50 pip range bar chart, which means that each of the candles are worth 50 pips. So when the market has set a low here, if it's intending to push up, If it takes 10 years before it makes that 50 pip push, then it takes 10 years. You're not going to get a new bar. The beauty of this is it removes all of that market noise that you would see on a normal Japanese candlestick chart so that it's very clear what the market is up to. Okay? It does that. It's very clear. This is a range bar chart. What do we have? And another reason, like, let me zoom out. Let me show you the entirety of what this looks like. And then what we're going to do is we'll go down to a regular time frame, and then you see for yourself and tell me if you don't notice the difference immediately. Look at this, and now I'm switching. This is a 30-minute chart. Look at all of that. Look at all of this. I'm not saying I can't trade it, but holy fuck, it's not pretty. It's not to me. If I go up to a higher time frame, okay, maybe it's manageable. But you want to compare that to this. Take a look for yourself and tell me you don't like this. And if you do like it, great. Check out C Trader. This is a platform that I use. It is free of charge. Letter C and then Trader, all one word. It's created by Spotware. You can go to spotware.com and download it directly from them. Or if you have a broker that has C Trader, absolutely check it out. You could, even if you're doing your trades still on MT5, you can do some analysis here and then use that to figure out what you want to do. So what you're looking at is a 50 pip range bar chart on the pound Aussie. And I said you can use a single candlestick to define the range. Look at this. So that literally means, for instance, if I was here and all of this hasn't happened, this could be my range right here. Let me drag this. This one candlestick that I have selected. I'll grant you, I did not see what it is I would have been looking for if we wanted to take it for a buy. But it is a range. Okay? Look at this here. That's a range as well. Each single one. So you get to decide, and we'll talk about different ways that you can use this. And please remember, when I teach, I'm not expecting you to use everything. I'm asking you. I haven't done this before, but now I will clear. I asked yesterday, but now I'm going to be even clearer about it today. Everything that I teach you today, I need you to pick one thing. You don't have to define your range every way that I'm going to show you. The next way you can define a range, number 3, is using swings. Now, what is a swing? Let me define a swing for you. The turning point in price. What do I mean by the turning point? It is the idea that the market has been pushing, excuse me while I move this. So the market has been pushing in one direction, and then it hits a sudden point where it starts to turn away from that same, it stops moving in that direction, starts to move in the other direction. How do you pinpoint this exactly? Because if you go, it's very clean here. It's clean to see on a range bar chart. But if I take you to a regular chart, you will notice there's so many swings. And I'll explain why. So if I take you to this is our 50 pip range bar chart once more. A swing is a 3-candle pattern. You are looking for 3 candles. Come here. 1, 2, 3. This is a swing high. Why is it a swing high? The middle candle has the highest high of the other 2 on its side, of all 3 of them. It's higher than this one. It's higher than this one. Notice how, what is it? I said it's a turning point. So the market gets here and U-turn. Off we go. Does every swing imply that the market's going to turn around? No. Because look at this one here, 1, 2, 3, that failed. I'm very deliberate about pointing out to you times when what I'm showing you does not work out, because I want it to be rammed into your head that sometimes things will not work out, because if you have that knowledge in your head, you're not going to take stupid risks and blow your account. Okay? So this is the literal turning point in price. That is a swing high, or you may call it a bearish swing. Over here, what happens? The market pushes down and then does what? Sharp break, U-turn, vroom. What do we have? 1, 2, 3. This is the lowest low here. This one is higher and this one is higher. If this were a time-based chart and you really think about the structure of what I'm showing you, a swing is kind of like a compressed version of those classic reversal patterns you've been taught in your textbooks and stuff on baby pips. The head and shoulders. Think about it. Head and shoulders. Inverted head and shoulders.
Why does it not work all the time? Well, you're probably using time frames that are too low, or you're not working with liquidity. And don't worry, I'll show you how to do that. You're not working with a story of liquidity. Don't worry, I will show you how to do that. But automatically, I want to say this. If you are using a pound, what am I talking about? If you're using a 50 pip range bar chart on an asset that moves a lot, I'm not talking about gold, because for gold, it would be a different figure. I'd have to figure that out, probably 500 or something, I don't know. But if you're using like the pound Aussie or something like that, that moves a lot, and you have a 50 pip range bar chart, that could be all you need, quite literally. It's very clear, and you know that at some point you'll be able to bag 50 pips or more. So think about that. It's going to take time to play out, but it'll be worth the wait. Okay? So we're talking about ways to define the swing, define the range. Now, how do you use swings to define a range? Excellent question. So think about what it means once more. A range is simply the difference between two price points. What happens here? The market pushed all the way up, came to this place, and it started to pull away, officially making this a high. The market pulls down and then starts to push up, officially making this a low. And what did they say? Highs and lows. This is your range, okay? All I did was identify one swing. This is a swing high. The market pushed down. This becomes a swing low, and officially the market starts to pull back up again. Now we have a range that has been defined. All right? This is using your swing to swing method. You could also do that on a high time frame, on with a regular chart. So let's see how you could do that here. Right? Let me get this out of the way. Notice we pushed up here, we started to pull back. This is a pound Aussie on the 4-hour chart, mind you, so these are actually significant. We pushed up, we started to pull back, we created this low, and then we started to push up again. As we created this low, 1, 2, 3, that's your swing pattern. This is why I'm not always a fan of time-based charts, because while I would have been waiting for this 4-hour bar to close, a range bar chart would have shown me already that, look, we have that swing, let's go, baby, let's go. Let's buy. I'm not saying buy every swing. I'm not saying buy every bullish swing or sell every bearish swing. I will talk to you about that in a bit. So just hold on. So what do we have here? This is that low. Gonna mark it. And then the market pushes up. 1, 2, 3. There is that swing right there. So what do? We mark the high as well. And then I drag that back. And what do I have defined? A range. So this is a swing low, swing high. That's your range. We've contextualized it. So now I know. So let's say this happens and maybe we get to this point here. Now I know, okay, what to do when the price gets to what point of the range. All right. So that's how you do that with a regular time frame chart. I keep emphasizing, please, if you are using range charts or time-based charts, you must use for price-based charts, always go for the highest number of pips that makes sense for your asset. Not too high that you never find a setup, but not too low that you keep getting chopped around. So let me go back to the range bar chart and show you what I mean. What I'm going to do now is I will take you to a 5-pip I'll take you to a 5-pip range bar chart. And this is the pound Aussie once more. Give it a few. It needs to populate before we can finally, see this? This is madness. This is insanity. Don't do this. All of this crap here. How do you deal with this? Hold on a second. Let me mark it because I want to show you what happens immediately I switch to a higher time frame. And the same concept applies if you are using a regular chart. If you find noise, it doesn't matter if it's on a range or whatever. If it's too noisy, you don't understand what's happening. This is also, to me, it's noise. I could scalp this, but I will not be doing that because why? But it's noise. So what can you do, or what do you do? Go higher. So now I'm going higher. Give it a bit. This is what you're about to see is a 20-pip range bar chart. And look at that. All of a sudden, all of that rubbish, look at it. Just 3 bars. Now it's clear. Awesome. If you are a scalper, this would have been paradise for you. Those of you who have already been coming, you know exactly what it is I'm talking about. Okay? If you want this even clearer, let's go higher. So that was a 20-pip range bar chart. This is a 50 that's about to show up again. And look at that. So that's off to the side a little bit, but the point is all of that price action is within here. All right? So let's go back to the idea of how to determine our swings. I've talked about how to use swings. I want to go back to candlesticks because I forgot to show you with Renko bars. So let's go to a let's try 50. Let's try a 50 pip Renko bar chart. So this is a Renko bar chart, which is different from a range in the sense that the range will give you wicks, show you the highs and lows, and it's not tethered to round figures. But for the Renko bar chart, it is. So this is it's probably not going to be easy for you to see, but this one, the open is 2.06, and then the close is 2.065. Okay, so it's round figures over here. That's why I said you could literally just plant your horizontal lines or alerts at these round figures and then figure it out for yourself. Hang on a second, let me put on my DND. Okay, so immediately you can see how much cleaner all of this price action is. This is a Renko bar chart. This does not mean, I want to be very clear, just because it looks like this, do not be deceived. Those of you who are new, do not be deceived. It does not mean that immediately the price opened here, then it opened here and it went straight down. There is a chance the market maybe pulled back a little bit and dirtied this area before pushing down. But because it did not pull back this is a 50 pip Renko bar chart, for it to create a bullish one, it needs to pull back by 50 to get here and another 50 to get here to give you that bullish bar. But it did not do that. So there was a chance the market pulled back as little as here or even as far as up here and then turned around. If you've been paying attention to what I've been saying, that should automatically tell you, I've just given you, those of you who are always particular about strategy, you're not listening to the story I'm telling, I just gave you another one again, which is basically the same thing that I gave you when I was talking about the trend and waiting for a high to be taken. Literally, this bar closes, you have one of two options. You can wait for the market to come back up here to the open of this bar and then look for some sort of reason on a low time frame, on a regular chart, break of market structure, whatever it is, something to tell you, oh, the bears are coming to play again. And then you hop in and you write that shit back down. That's option one. Bearing in mind that the market may not always push back. And it's fine. It's fine. It's okay. I need you to be okay with the market running away without you because you haven't seen your setup. Don't chase everything. Option number two is, because you know you're using a Renko bar chart, you can make your own projections. So pretend for a second that this bar here has not been created. Where my cursor is, this one hasn't been created, but this one has. You can go ahead and grab this guy, this your square or horizontal lines, and go ahead and make that projection. And then you can say to yourself that you're going to treat this line, which is the open of the next bar, you're going to treat it as the area where you're looking for that turnaround. So in other words, you've created your own external, I'm getting ahead of myself. But anyway, you can use that, look for a reason in a lower time frame to be a seller. When you get that, you sell. And then automatically, because you're basing this off of a 50 pip range bar chart, Renko bar chart, you know that you can either try to hold for 50, or if you want to be safer and you want more guaranteed wins, you could just hold for half of 50, 25, 30 tops. Let me go back to what I was talking about. Where's my notes? So we've talked about two random lines, any candlesticks, using swings. And if you think that there are no swings on a Renko bar chart, you'd be very wrong. Let me show you. They're right here. It's just that you'll have to think of them a little differently. So let me reduce this. Look here. 1, 2, 3. Turning point in price. Remembering that just because the market closed here does not mean it's immediately started to push down. No, there is a chance the market may have moved maybe 1 pip, maybe 49 pips, maybe 49.9 pips before it started to turn back around. But either way, this is your turning point here. That's a swing. And one thing about swings, again, listen to the definition of a swing. If it is the turning point in price, then I should be able to use the swing to predict where the market should be heading next. And if I am using it on a high time frame or a high range frame, as in the case here with the Renko bar chart or with a range bar chart that I showed you before this one, that means I should be able to predict that the market's going to push in that direction for at least a little bit. If you, those of you who, I know there's some people who really keep going back to my videos over and over. And if you pay attention, there's sometimes where I sound a little too cocky. It's annoying. But the reason I can sound that way is because I know that I'm working with the higher time frame. Every other chart below the monthly must take orders from the monthly. The weekly takes its orders from the monthly. The daily takes orders from the weekly and the monthly. The 4 hour from the daily, etc., etc. Depending on what you're trading, this is GBP AUD. I would also consider the 1 hour chart as a high time frame in its own right. But that's because me, I'm a scalper, so don't follow me, okay? Try to think about your own personality and what it is you like to trade. But ultimately, if you have that high time frame swing and you pair that with the idea of liquidity, which we will talk about shortly, then you can be almost certain, more often than not all the time, not all the time, but more often than not, what the market's likely to do. And you are not interested. Don't be greedy. You don't have to look for these monster moves. You just need to take a little bite and be okay. If you want to take a monster move, okay, that's great, but don't be upset when the market comes back and wicks you out or something. Or at least try to take something off the table. Anyway, this is a swing, 1, 2, 3. This is another swing here, 1, 2, 3. Understanding that it's not that the market came here and immediately turned around. It may have pushed down for just 1 pip before turning around. It may have pushed down for 49.9 pips. Remember, this is a 50 pip Renko bar chart. It may have done 49.9, but it wasn't able to make that 0.1 that would have made it 50, and then it turns around. I'm giving you this for a reason. So now we have a swing here, and you have a swing here, like so. So I'm marking this low, and I'm marking that high, and now you have a range. How do you know you have the range? You have that swing, you have this willingness to continue pushing back up. Well, there's your range. All right? So, where are my notes? Let's see what it is I haven't covered. Now, the reason I've been talking to you about ranges is because the range is how we answer the question, where's the money coming from? Where's the money going to? Is there enough room between these two places for me to take some for myself? Where's the money coming from in this case when you have this bullish close here? This has been closed here, okay? So where's the money coming from if you're projecting and you have this bar hasn't formed yet, but you know you're using a Renko chart, right? And now, so you go ahead and draw that box here. For you, if the market closed here on this one and it's opening here, so then the market is coming from here, or rather the money is coming from here or slightly below it. Where's the money going to? You already know this is a Renko bar chart, so that means that you know you've already plotted 50 pips away from the current price. So you know the market should, emphasis on should, let me replace the word should, probably go here. That answers your 2 questions. Question number 3, is there enough room for me to take some for myself? This is basically you ensuring that you are not using a range frame or a time frame that is too low. This is a 50 pip range Renko bar chart. So hell yes, there is enough room. Are you kidding? There is enough room from this point to the next 50 pip area. Of course. And that answers your questions. So when you have all of these defined, now you're set. Now you may start thinking about, okay, how do I trade? So if you're coming fresh to the chart, if you're lazy, and you don't like stress, and you don't want to overanalyze, you've noticed the market has been pushing down, it's been pretty bearish. Sure, there was some kind of retracement and the price stalled here. It pushed down again, and sure, it's pulled back up. But what can you start telling yourself? All right, so this guy, and this is not a signal, please. Do not go and take this trade. If it loses, you're on your own. I have no responsibility for that. You come to the chart fresh. This is what I see. Great. It has closed here. Okay, awesome. And now it is retraced back to the top side, which is beautiful. Now I want to see if I go to a lower time frame, like maybe M15 or some shit, am I going to see something that I can use to sell? All right. So let's go back to our notes here. Give me a second. I need this to load again. So, where the heck? Okay, there we are. This money is liquidity. Anytime you're watching any video on YouTube And you're wondering, what do they mean by this liquidity thing? It's money. Don't deep it, it's money. That's what it is. So now that you have your ranges, the question is, where do you find liquidity? Wait a second, my broker is doing a changeover thing, so I have to wait for it to load back up again. Just give it a few seconds. Today, please. So where can you find liquidity? Where's my notes? There they are. I'm going to stretch this down. Where, let me move this back so there's no confusion and put this in brackets. Where can you find the money? Liquidity. Number one, you have two kinds or two areas, two basic places you can find it. You can find money outside of the box, which is the range, okay? And we call that external range liquidity. You can find money inside of the box, which is also the range, which is internal range liquidity. Mon eye. So let's talk about the first one first. Money outside the box, pretty easy to find. Number one, how do you find money outside the box? So I'm going to put, this is how I shorten it, please. I don't like having to type all this shit. So for me, liquidity, calm down, calm your pants. So for me, liquidity, I just spell it LQDT, okay? I don't know if anyone else has done that before me. I don't care. It makes it easier for me. Liquidity, when I'm talking about external liquidity, I'm going to go ELQDT, okay? Liquidity. So for external range liquidity, you only need to look at two places. Number one, highs. And then number two, lows. In other words, the high of the range and the low of the range. Okay? Then for internal liquidity, you're just looking at two. There's multiple kinds, but I reiterate, I must stress this. I keep teaching only two because in my humble opinion, you do not need more than those two. If you start going out to research and learn some more, that is on you. You only have yourself to blame if all of that extra information just confuses you. I keep it to just two because I'm looking to help you focus so you do not start seeing all kinds of things all over the place. So internal range liquidity, we have number one, order blocks. And number two, we have fair value gaps. And we'll talk about both of those now, for which I will take you to a regular time frame chart, regular time-based chart. You're looking at H4 again. For an order block, let's move this out of the way. I'm going to show you right here, we're looking at a bearish example. So you have a low. This is the low. Why is it a low? 1, 2, 3 swing formation. This is where the market started pushing up from. That's a low. This low gets broken by this bar. As soon as the low is broken, the last bullish candle that led to the move that pushed down would be your order block. Now, technically in this case, it would look like it's this guy. Maybe not the best example really, especially for beginners. Let me go to H1. Yeah, let's use H1 instead. You have this low gets broken. As soon as this low is broken, this last bullish candle that led to the break, that sponsored the move rather, that broke this low, that becomes your order block. The whole idea is the people who make the markets, they have large orders to fill. We are just small fish in this large ocean that is Forex. And so they cannot just put all of their orders in at one go, because if they did that, the market would just shoot straight down or straight up, which means everybody would be happy. And they can't have that because there must be winners and losers. So what happens? They've put some of their trades in here, the market pulls away, breaks a low. Now, this bar here is where they'll be retracing into to put the remaining of their orders in. And it does that. So now that you have this information, you could very simply have your pending entry here and your stop loss above there. And then you'd be looking to write it. If you've been paying attention at all, what is this? This is a low. This is a turning point. The market was pushing down and then it turned around, pushed up. And then it turned around here. So now you have a range. So if you're trying to sell here, you could be looking to take profit inside of this range. And we'll talk about that in a bit. But this is your order block. This bar here. That's a bearish order block. Let's look for a bullish example. Over here, 1, 2, 3, not the best swing, but it is there. This bar breaks above it. Once it breaks above it, the last bearish candle that sponsored that move becomes your bullish order block. So let's change that color and change that transparency as well. Notice how they came back, tapped into it, and then took off from there. Something to note. When you have, this is another example here. Look at this low. This low gets broken. Once it's broken, the last bullish candle that sponsored the move, that becomes your order block. So let's mark that one out. And notice how it came and it almost touched it. Now I have a note to make. If you notice that the previous candle before that order block is the same direction, same color, you can stretch it to cover that as well. And now you can see that this tapped into that order block and pushed away. Not every order block is going to get tapped. Not every order block is going to hold. I need you to keep that in mind. But it's something stable enough that you can exploit. Okay? So that's one form of internal range liquidity. And why is it called internal range? I need you to think about this. Why is it called internal range liquidity? The market pushed down. Where are we? From here. We have this push here, pull back, and then push down here. Okay, great. Actually, I want to go down to H4. It's going to be clearer to explain. So why is it called internal range liquidity? Think about this fact. The market created this high, pushed down. There was a bit of a pullback. When this pullback was happening, this officially would have been your range, right? But then the market actually traded beyond that point, so we'd have to extend it to accommodate that. Hang on a second. Here we go. Give me the middle. Thanks. So we're extending it to accommodate that. When the market starts to turn back in, where is the order block in this situation? It's inside the range. So this is the money inside of the range. Okay? Let's remove these little guys from here. This is the money. The internal range liquidity, the money inside the range, the money inside the box. And how did I create that range again? It's simple. You have a high, you have a low. Why didn't we stop here? Well, we did at first, because remember, all of this hasn't happened yet. We don't know. But then when you notice the market is pushing down further, you have multiple options. You could say you want to use this as your range if you want to. You could say you want to look further back. Heck, you could say to yourself that you want to measure the entire thing like this. It's up to you. But this is also why I'm not a big fan of Japanese candlesticks, because there's so much subjectivity. That's why I love me a Renko. That's why I love the range bar chart. Okay? So we've talked about one kind of liquidity, and let's talk about internal range liquidity. We've talked about one kind, let's talk about another type. The fair value gap. This is a bearish example. So you're looking at, hang on a second, TikTok wants me to confirm that I am a real human being and I am still here, or else they will end the live and kick us out. So give me a second while I take care of this. Dragging the puzzle piece here. Yes, I am real, I am alive. Okay. Fair value gap. What you're looking for, it's a 3-candle pattern, okay? You have a low, it got broken. Not only did it create an order block up there, which we went down to the H1 for you to see it properly, but look at this candle here. When this one closed, and then this one opened and closed, it left behind this space between the low of this candle and the high of this other candle. This space between, it's just pure selling pressure. So it was all selling, no buying. And the market and Mother Nature does not like imbalance. So what happens? The market will sooner or later, excuse me, let me draw this properly. Sooner or later, it will have to come back in here. Sometimes it will tap it just by like 1 pip and then take off. Other times it may push all the way to the top side and into what would have been this order block or whatever. Okay, but the point is the market must come back to rebalance this pure selling pressure by offering buyers a chance or by offering buys a chance. And then it does that and then it takes off from there. Okay, here's another example here. Grabbing this and then this. This is a 4-hour chart, pound Aussie, once more. So notice the market created this. You have this, and then you have this, and then you have this. There's this space here. What happened? When this guy came and tapped in, it doesn't look like much, but if we measure from the top to the bottom, that's 55, almost 60 pips. From top to bottom, almost 60 pips. So what could you have done? You could very simply have said, okay, I'm going to set an alert for when the price hits this bottom here. Let me grab a vertical line so we can see how we could have traded that. And then you can go down to maybe the 15-minute or the 5-minute, whatever. It's up to you what you define as your low time frame. Okay? I think I made a mistake here. Hang on a sec. With the markings. Yeah. Okay. So what time was this? 6 p.m. Okay, cool. 6 a.m. All right, cool. So let's come over here. And now, what do you have? This is a 15-minute chart, mind you. The market retraces into here, like so. What could you do? You could wait for a break of structure. Is this a break? No. Why? Because this is a low time frame. These are just wicks. I would never count a wick on a low time frame as a break. This is that thing we talked about before. Those of you who are here at the beginning of the live, where we talked about the fact that sometimes the market will create a low. It's trending, it's pushing to the upside, it'll create a low, and then it comes and does this, and you're thinking to yourself, yeah. Let's sell. No, this is that opportunity for you to be a buyer. So it pushes into this area here, this white area here. This is that fair value gap from the 4-hour chart. And then what does it do? You have this low, and this low eventually gets broken. Once it's broken, what do we have? Number one, you have the order block. And what did I say about the order block? It's the last bullish candle. But if you notice the previous one's also bullish, you can go ahead and mark that. What else do we have here? We have a fair value gap as well on the 15-minute time frame. So all you'd have to do is just see this. He could set a pending order here. Have your stop loss at the top of the second candle, or to be safer still, beyond the swing. Okay? So we've gone over the two kinds of liquidity. And now I want to ask you a question. Not for you to answer me directly, but for you to go and think about for yourself. The question is, I'm going to type it here, get this out of the way. The question is very simply, what sort of trader are you? What sort of trader are you? So I need you to think of this literally as money heist. I've mentioned this analogy before, but I'm going to add another thing. I want you to imagine, so typically with gangs, and this is not me promoting stealing TikTok, it's just an analogy, please. So this is a thing. When you have a gang that's a hit squad or whatever, you have someone who's a pro at cracking locks. You have someone whose job is transportation. They're very good at driving, weaving through the ins and outs, navigating their way through whatever. You have someone who's good at intimidation. Oh, open the safe, whatever. Okay? Everyone has their place for a reason. If you have your lock expert as the person who's in charge of, say, keeping everyone in the bank under control, that's a problem, because you're going to have a failed run. That's not going to work for you. Everyone needs to do exactly what they need to do. And it's the same thing here. So I've always said, where's the money coming from? Where's the money going to? Is there enough room between these two places to take some from me? Let me grab two rectangles and show you what I'm trying to say now. All right. So let's say this area here, what this is, it's not a range. I'm just talking about it as a location. Think of it as a building, and this building is called the Mint. It is the Mint where all of the money is being printed before it gets distributed to banks. And then this is your bank over here. And your job is you're supposed to get the money from the Mint to as it's coming out of the Mint. You want to get in, steal something really quickly, and then get out before the van gets to the bank. Why is that? If the Mint and the bank are so close to each other, hang on a sec, I hate seeing these period separators. Oh, better. If the Mint and the bank are too close to each other, for all you know, they may have an underground tunnel system that is just what they use to transport the money straight. And if you try to hit that, the odds of you getting caught are really high, because there'll be lots of security measures in place and they'll have lots of controls for all kinds of scenarios that you may have envisioned yourself. But if it's a situation where you have the Mint all the way over here in maybe on the mainland, and then you have the bank here on the island, now there's all kinds of obstacles. You have to pass all kinds of roads. You have to deal with some good roads, some bad roads, some places that have poor lighting. There's all kinds of things that could go wrong. The best thing they can do is just make sure that, okay, there's someone who is securing it. They've got some security with the bullion van as well. But this gives you lots of opportunity for you to come and take something for yourself. So I've given you these two places. Now what I'm going to do is stretch them out and make them one. What I'm basically saying is this whole box is your range. And the question I want you to ask yourself is, what's your area of expertise? You can't be a locksmith and you're trying to keep everyone under control. It's not possible. You will not be able to focus on both doing that and then getting the money out of the vault. So what is your role as a trader? Are you the kind of trader who waits for money to pop outside of the range? So if it's a sell, let's say this is a bearish trend. You're waiting for the market to pop outside of the range, and then you're waiting for a sign that says, okay, it's ready to turn back around. If you are that kind of trader, then define yourself as that, which means every time you come to the charts and you've marked out your high and low, you're not interested unless and until the market trades back to that level. And then not only are you aware of where you need to get in, you already know where to get out. So there's something I haven't talked about yet, which is when it comes to the range, there are 3 price points. Number 1, equilibrium. Number 1, equilibrium. God damn it. Number 2, premium. And number 3, discount. Okay? So let's say this is your range. 50% of the range, the halfway point, that is equilibrium. Equilibrium is another word that means balance. It means there's a balance of buying and selling activity here. It also means anything could happen. The market could shoot one way, shoot the other way. You don't know. However, this is where it gets interesting now. Everything below that 50% point, that equilibrium point, is called discount. So when you have formed your range, remember I said, what did I say at the very start of this? That it is when you have determined what the trend is that you should now move on to the job of determining your range. So once you've figured out your range, and let's say you're in an uptrend, you only want to be a buyer when the market is in the discount portion of the range. So you could be also the kind of trader who, let me bring up an actual chart. Let's take a look at the 50 pip range bar chart, for example. I'm going to go back to what I was saying, but I want to show you the practical example, so we're not just looking at squares. Load already, please. Muchísimas gracias. Let's see, is this dark as well? Okay, good. This is your JPY 50 pip range bar chart. So you could be the kind of trader who, your thing is, you show up to the chart. Where's my rectangle? Give me my rectangle. You show up to the charts. Let me right click this, change the color so it's visible. You show up to the chart. Do me a favor and pretend all of this hasn't happened. This is what you see. this bar has closed, which means this one is open and it's doing something. So what kind of trader are you? The first trader I defined was the one who would wait until the market comes and trades above this high, and then they would wait to see if there's a sign on a lower time frame for it to turn around and then push back down into this range. This whole range here, this bottom section, that is the discount portion of the range, but we're in a downtrend in this example, which means, I forgot to say this, you have your equilibrium, you have everything below equilibrium as discount, okay? And I said you only want to buy in a discount when you are in an uptrend, please. When you're in a downtrend, this portion and upward, you're 50% above that, that's your premium portion of the range. So you'd be looking to sell. In this case, it wouldn't have given you that setup, but still, think about what I'm saying here. Are you the kind of trader who would have to wait for the market to pull all the way back because you've decided that you want to only attack highs and lows? So you're waiting for the market to pull back to this high, and you're waiting to see on a lower time frame, is it turning around? And then what you want to do, if it is you're going to sell. The first place you're looking to take profit at is at least 50% of the range. Why did I say that? Because anything can happen, because that's balance, because that's like a decision point. Okay, now the market has to figure out what does it want to do there. It could very easily turn around. The second option is, you're trading with a 50 pip range bar chart, right? So wherever this market is turning back from, this is the high it made, you come and you measure 50 pips. Remember, all of this hasn't happened yet. You measure 50 pips away from that and you say that's going to be your take profit. Okay? That's one option. Option number two is the chart, you come to it and this is all you see. But you are the kind of trader who takes money from inside and outside. So you're not going to wait until it comes outside the range. You're waiting for the market to give you the money inside of the range here. And then you take that money outside the range. So let me show you an actual example of the previous one. Or let's look at this one first, and we'll go to the previous one. Look at this. This didn't retrace into 50, I don't think, but it'll have to do for now because I'm running out of time. So this is a 50 pip range bar chart. What I'm going to do is I'll take you down to the 30-minute chart. Let's look for that. You're looking at the 30-minute chart. This here was when that range bar closed. Look up and to the left and start asking yourself, what exactly exists? This is kind of the 50. Let me get my Fibonacci so we're not just guessing. From here to here. So it did. So at the 50% level here, what is this? Let's get that out of the way. I need to delete that. You broke a low. What is this? This is an order block. What did the market do? Look, it came and tapped into it. So once you have that range figured out and you are the kind of trader who takes money from inside the box to outside of the box, what do? You come to a regular time frame chart and then you're looking at 50% of that range, what's there? And above 50%, what's there? Okay, we have an order block. Nice, taps into it, takes off. If you were waiting for this to get hit before you start making a move, well, you wouldn't have gotten a move, and that's fine. It's okay. You will find something eventually. Let me take us to a different setup now. Let's look for something on the bullish side. Okay, yeah, no, before I do that, I want to show you this one as well. I'm going to delete this because there's too much noise on the chart. Let's mark this, okay? Look at this. Why this in the first place? Well, we've been pushing down. Look at the down moves and measure. That's a lot. This is almost 200 pips. This is quite a dramatic push again. The pushes to the upside, they're not as much. So let's err on the side of caution and let's look for a reason to be a seller. So let's say you came around and you saw this. Awesome sauce. Now what? Let's go down to a lower time frame and see how you could have exploited that. So I'll take you down to a 30-minute chart once more. Am I looking at the right thing? Was it this guy? Size. Yes, it is. This is a 30-minute chart. Because I know what I'm looking at, if I'm looking at just opens and closes, I can already see this was a break in structure, but I don't want to confuse you. I'll take you to 15 because I need you to see it. I need you to see it for sure. So this is that range. This is that break in structure that has happened. What did it leave behind? A fair value gap. What did it also leave behind? This is an order block. So once this has been created, this is that bearish range bar. Now you're waiting for the market to retrace. You have an alert at 50%. And once it goes off, okay, you're looking at it and it's like, oh, I see this. Okay, well, you can enter or you can have your pending order here. Your stop loss is above there for about what, 15 pips. And then you already know you're watching the charts, and as time passes you realize this is the high it's created. So let's say all of this hasn't happened yet. What do? Since this is the high it's created, if you want to hold it for an entire range bar chart, what do? You're going to measure all the way down to 50 pips, and then you know, okay, my take profit is going to be somewhere around here. That's a little over a 1 to 3 trade. Tell me that's not decent. Tell me that's not decent with a decent lot size, decent risk on a decently funded account. Let's go and look at more examples. Let's look at Renko's. I'm gonna do. I'm looking for. Where's my 25 pip? All right, cool, right. So, marking this here. This has already formed. I'm just marking it for convenience. So we cannot use this, technically. I'm just marking it so when we go down to a lower time frame, there's no confusion. Here as well. So this is a 25 pip Renko bar chart, meaning each brick is worth 25 pips. Now let me lock everything in place, and then I'm going to, oh crap. Hey, now change the color. Okay. And now I'm going to put a vertical line on here. It's a random example. It's a random example. Technically, you shouldn't be trying to buy in this one. It's just a random example, guys. Because I have to get out. So this is a 5-minute chart now. This was the moment that first bullish Renko bar closed for 25 pips. So you can ask yourself a simple question. And if you've been listening to me, in a sense, you could simplify your life by just using that one brick and saying, okay, let me use you as my bias, my short-term bias, especially for those of you who scalp. All right? So this is a 5-minute chart. These blocks here, they represent that 25 pip Renko chart. What happened? You would just be looking down and to the left. What in this area here looks like something the market may attack? Down and to the left, below 50%. Because why? We're looking to buy at the discount. So what can we see here? This is a high that got broken. Once it got broken, what is this? This is a bearish candle that is not just a bearish candle, but is your order block. I'm going to mark it just for the sake of transparency. Let's right click this and make that transparent as well. Look over here and see what happened. The market came back to it, tapped it beautifully because it's a 25 pip bar. So how do you enter this trade? You could have a pending order here. A pending order here or at the body, that depends on you. Some people like to use the entire thing. Some people use only the body. It's up to you. But then let's say you entered here. Your pending order is here and you have this 7 pip stop loss. The market comes here, taps you into the trade, does not take your stop loss, and takes off. You know to get out here, or at least by the time it's 50%, depending on how much you've risked, you could take something off the table, or at least move your stop to break even. Okay? So in that sense, what kind of trade have you executed? You've taken money that is within the range and taken it outside of the range. Remember, this range here, we're talking about this particular box. Okay? That's one way you could have done that. And in a sense, actually, if you're looking at the order block itself, the body where it's tapped, it's still within, but if you're looking at the wick, it's actually outside of the range. What can you do here? This is another example. Excuse me while I stretch this out for you to see. So the market has pushed all the way to the top side. It didn't quite make it all the way there, but remember what I said about making your own projections. So at this point, the market hasn't pushed there, but you have that brick already printed out on your chart. Either you're using a rectangle or you're placing it with a line, whatever. The point is it's 25 pips away from the last one. So you notice the market has pushed up here and is starting to pull back. Into what? The discount portion of the range, right? Well, what's in the discount area? We have this fair value gap here. We have this order block here. Why is it an order block? This was a high, it got broken. Once it got broken, this order block was created. Let me zoom in a little closer so you can see. Again, this is a high. No, this is the high, sorry, because we're looking at this brick here. So this is a high, this gets broken, and then that leaves behind this order block. This one closes, and that leaves behind this fair value gap. And what I have not said yet on this live is if you see a fair value gap next to an order block, it's telling you that order block is a high probability one. And what happens? The market eventually taps into it and then takes off. Okay? And this is what I mean by sometimes you will not get that opportunity, that retracement, and it's fine. This just ran away from you. It's fine. If you wanted to, maybe you got in and then you taken some money off the table and then you want to let it run and you're just telling yourself, if or when the market changes direction, then I will be out of the trade. That's up to you. It's fine. Okay? In this particular situation, here you are. The market is pushed up and finally it's giving us some sort of retracement. And you're looking at all these breaks in market structure and thinking to yourself, oh, okay, yeah, we're definitely going down now. And you would have been not wrong, but early. This is that trick they're playing on you again. So they bring you down here. And then you notice that, wait a minute, this bar just broke this high. Not only did it break this high, in the process it's left behind this fair value gap, this order block here. And so you're watching. And then the market does what? It taps into the order block. This wick is very significant. It's telling you it could not push and close beyond the order block, so probably it's valid. It's rejecting it. And then you have this last candle here, which is a swing formation. What did we say a swing is? A turning point in price. So if you were not confident about having a pending order here, then what could you have done? You could have waited, you see the swing, great, your stop loss below the swing, or if you want to be even safer, beyond there. Where's your take profit? 25 pips away. And you can do this with any pair and all pairs. Any and all pairs, it's up to you. For me, my username is I take ticks for a reason. That's because once I have identified, let me show you now, those of you who keep asking how exactly do I trade when it comes to scalping, this is your answer. I'm going to take you to the trade I took today. It was on EURUSD. Where is it? Hang on a sec. RUS. Okay. This is EU. The first thing I noticed when I came to this chart was on the daily, is that when I came here, I noticed that this low had not yet been taken. I noticed that this candle had formed, and we were somewhere around here. And so I was anticipating that we're going to take this low at the very least, which is about 30 pips away. Okay? Roughly that. So the next thing I did was what? I'm going to put a line here so you can see exactly what I'm talking about. Put a line. The next thing I did, I dropped down to the 30-minute chart just to be sure. Oh dear. No. It was yesterday rather. When I came in, let me go back to the daily chart and be sure. Yeah. Yep. Accurate. So when I came in here, I noticed that this candle had closed. I noticed it had a lower close than this guy. This the open, the close. Let me show you something. I'm going to switch to a line chart. So basically, this low here, the market had closed beyond it. So that's another little trick for you to figure out when something is turning around, because if you think about it, there's no actual swing here. So how do I know this is a swing? I can eyeball it with this chart because I can see that this candle, it pushed up, it closed here, and from there it went on to push up here. So if you're using a line chart, these wicks wouldn't show. It just shows as a V, which creates that low. So I knew when I saw this that it was broken. So what's the next thing that I did? when I realized that. I went down to a 5 pip. Why did I come to the 30 in the first place? I just wanted to be sure that I liked what I saw. I saw this, I saw that it broken. I was looking at this as an order block, and I loved that this candle closed like this because it was showing to me as the rejection of this order block. If I go to a weird time frame, maybe above this push up and push down, which you may have heard defined as railroad tracks, they're basically going to be a wick. Think about the anatomy of a wick. It opens, it pushes up, and then it pushes back down. If you combine these two together, I don't know if it's going to show on the 1 hour as that wick. I think it did actually, in a weird way. But either way, I was just trying to ascertain that we are actually ready to go down. So what's the next thing I did? Then I went down to the 5 pip Renko chart, which is here. This is where we were. And all I did, very simply, was I started lining my charts. And actually, you can go on my page and see this breakdown for yourself. I lost a few trades in the process, but I wound up making money. And this is what I keep trying to tell you. You don't have to win every trade to make money. So just indulge me, please, while I draw these boxes so that there's no confusion. All right, so there we go. And then I'm going to lock these as well. Lock. There. So now that I have these in place, remember, none of this shit has happened. It hasn't happened yet. I need you to keep that in mind. It hasn't happened yet. I'm just drawing those boxes out to help me with a visual for, okay, these are my ranges to be considering. Then I went down to a 10 tick chart. And that's why I got my name. I take ticks because I like to be in and out quick because I like freedom. Where is that? Yeah, here we are. This is a 10 tick chart. It's the closest approximation the C Trader has to a seconds chart. So it depends. There's multiple kinds of ticks. You could choose a 10 tick, 1,000 tick. That's up to you. And what do we have here? Let's start from here. Let's start analyzing it from there, even though I don't think that's where my entry was. I'm not sure, though. You can go check my page and find out. So what do we have here? We have this low, and then this guy gets broken. Okay, that's great. But it starts to pull back in, and I'm thinking to myself, all right, I'm at the top of this, and I'm looking to take advantage of it to the downside. And I'm looking over here. I can see that there is a fair value gap situation. Let me zoom in. It's a tick chart, so it'll look weird. There's gaps and all kinds of things. But if you look carefully, this is a gap well within its own right. Why would I trust this gap? I would trust this gap because I have already framed my bias. I went to the daily chart, remember. So the whole idea is I have found the liquidity that I'm looking to target on the daily, the liquidity that is drawing the price down. All right? And I'll touch a little bit on that before I get off this live. So I can trust what I'm doing here. And I already have this brick. And the whole idea of me having a Renko brick is if the market starts to trade too far up, I will not be interested anymore. That immediately tells me I'm wrong. I'm wrong. So all I'm going to do is wait until I get another brick that prints in my direction. Or if it does not print in my direction and it starts to come back, okay, come back to here so I can start looking for a setup. So what do you have here? This is a gap. The market traded into it and then took off. 5 pip take profit nicely, or 10, whatever. You want to write it, no problem. Look here again. What do we have? This. The market trades up into here, starts to pull back. Remember I said you can actually use the open of the next bar. If you don't want to treat this as a closed type situation, you're waiting for that pullback, you can project, okay, great. I'm assuming that you are the start of a next 5 pip Renko bar chart. Renko bar. So if you wanted to, okay, maybe you could take a chance on this swing. But it's possible the market could have wicked you out. No problem. What else could you do? This is a low, it gets broken. And then the market pulls back up. This is a tick chart, so it's kind of weird. But for me, I like to, when I have these things, I pay attention to engulfing bars. So what's an engulfing bar? You should know, because I'm not speaking to beginners. This is engulfing this guy here. I see this, okay, great. That's a good setup for me to sell. Okay? When the market starts to come here and it starts pulling back up, okay, let's see if we're going to get a break to the downside. Eventually, what happens, the market does this, gives you this wick, pulls back up here. I know it sounds funny, it sounds tricky, but hear me out. Because you have already framed this entire trade as bearish, and because you are using this 5 pip limitation from here to here, this is just 5 pips, then things become significant. So even this turn here, everything becomes significant. Look at this turn here. What is this? This is a fair value gap. It does not matter if you're looking at a tick chart or a high time frame chart, the same things happen. It came here and it made a what? Swing. And what is a swing? A turning point in price. That is not an accident. So you could have been in there. If you don't like it, and if you're on a tick chart, you want to be really quick about things. If you get a break, look at this low, this gets broken, that could be enough. It just means you'll have your stop loss a little bit further back because you know the market may retrace. Okay? Let's look at another example. The same thing here. What happened? The market starts to pull back. Okay? Now that it's pulling back, what are you doing? You're looking for anything, any reason here or above here. If you are the kind of trader that takes money from outside and you go back in, this is your bread and butter here. Okay, so the market's pushing up. It pulled back down into this fair value gap. It pushed up again. All these gaps, try to fill them in your head. So obviously the market opened up here. That means you could put a bullish candle in your mind here. It pushed all the way up here. And now what? If you look to the left, first thing, the interesting thing is how everything I've taught you now starts to overlap. Notice how this is a range here. Notice how you're kind of at the 50% point. What's at the 50% point? What did you have on this side here? This was a low that got broken. This is an order block. This last one here, or you could mark all of them. But what happens anyway is the market trades into it and starts to reject. Look again. If you didn't like that setup, no problem. This is a low. The low got broken. Once it got broken, this is an order block. Once it pushed on to create this, it gave you a fair value gap. And then it trades into the gap and then creates a swing. What's a swing? Turning point in price. Rejection. So what did it do? If I go to a higher tick chart, this will look like a wick. Think about it. The wick, the swing. Okay, I haven't said this one before, so I'll say it again. I'll say it for the first time rather. So you know those head and shoulder patterns, inverse head and shoulders and head and shoulders are supposed to be reversals. The only way that they work is if you're using liquidity and high time frames. If you are on a low time frame using it is because you have hinged that setup on a high time frame ultimately. And what I'm trying to say is this, that the inverse head and shoulders or head and shoulders is not unlike a bullish swing or a bearish swing and is not unlike a compressed wick. Remember, because price is fractal, I won't repeat that one more time because I don't want to confuse you. Either way, this is a low, it gets broken. This is a fair value gap. The market taps into it. 1, 2, 3 swing formation. Your entry is here. You want to be really bold. You have a great broker that has a tight stop loss like mine. Tight spreads like mine. Okay, 0.8, maybe 1 pip. And then you write that shit down. Easy 1 to 3 or 1 to 5, whatever you want to. What is this? A low, broken again. Once it's broken, what do you have? A fair value gap. And this is another thing that I have not said before. Do you know that if you don't want to, if you don't want to stress yourself, you don't like stress, and you are at peace with a wide stop loss, you can simply use the creation of that fair value gap instead of waiting for a retracement into it. I've not said this one before as well. You could use that as your entry. So what do I mean? This is a low that gets broken, and in the process, as this candle closes, you have a gap. You have multiple gaps actually. I could simply say I'm going to short this and have my stop loss at a safe distance away. Why? Think about what the fair value gap is showing you. Think about what a fair value gap is showing you. It's showing you that for XYZ number of candles, I'm going to push in the direction of that gap. And remember, we framed this. This is based on the 5-pip Renko bar chart, which is based on that daily push to the downside, which I said I would talk about. Thank fuck I remembered. So the concept of what is the draw on liquidity. When I say draw on liquidity, I'm talking about the magnet. That word draw there simply means what is pulling, to draw close, to pull, to magnetize. When you are on a high time frame, if you can ask yourself, what exactly is calling the price right now? What level is calling the price? Then it becomes easy for you to trade, so that even though today I got stopped out on a few trades, or I got stopped out, my stop loss got hit, I didn't care because I knew ultimately we're coming to this low, which means ultimately I will find an entry that can take me to that low. I didn't hold all the way for the low, to be clear, but I did take something off the table. Does that make sense? So in this case, you're looking at a daily chart. What can you see of this daily chart? Let's talk about it. You have this high here. It got broken by these series of candles. Awesome sauce. Then you had this turnaround over here. Great. So now what do we see? This was the lowest point from which that move started. Then you started to get that turnaround and a push down. Automatically, what do you have? You have a range. Stay with me. I'm about to show you how you determine the drawn liquidity based on your high time frames. So hold on a sec. So I've marked out the high and the low. Okay, it's a series of daily candles now. Now, what's the next thing? What did we talk about? The market pulls down into the discount portion. What's in here? That's the fair value gap, which the market taps into and reverses from. As it starts this turn to the upside, what do we notice? This is still our high, but now this is our new low. So which means we have a new range to think about. And now we're moving to the premium portion of that range. What do we have there? This is an order block. Great. What did you notice? The market traded into that order block, but not only that, over the next couple of days, it gave you a swing. What did we say a swing was? Turning point in price. And then it followed through on that swing. Boom. Closing powerfully to the downside, forcing me to ask myself, with this sort of push, what are the odds? Because it's closing into, I don't think I've talked about this before. If I go to a lower time frame, let me go to the 4-hour chart, see if I can find it. Yeah. So I'll take you to the daily once more. Look at this candle, this bearish candle. Let's highlight it. I want to show you something. I want to show you, because of experience, I know that's an order block on a lower time frame. Hang on a sec. Let me just mark that. So I love this as well because it's for you to see that it doesn't always work out. Order blocks don't always work out. So this is on H4 here now. This is that push fair value gap. If I go to an even lower time frame, I'll be able to find it. But ultimately, this is an order block as well. And that gets disrespected hugely. So why am I pointing this out? If the market is closing so strongly into an order block, it's not wicking. We talked about wicks before, remember? That wick is a clear sign to you that, yeah, we might be wanting to turn around. But this was so disrespectful. It just pushed and there was all that selling pressure. And bear in mind, it's a daily chart. One single day, this huge move, and then it closes so close to the low. That should tell you the market does want to continue to the downside. And it did. As of when I came, this was not a bearish candle. It was still kind of, well, it wasn't this bearish is my point. So now, all you're doing is you're looking, it was still bullish as of when I came in actually. All you're doing is you're looking, okay, if it's closing this strongly, then the odds are high it wants to take out this external liquidity here. External to what? This is the range, remember. This is our new range now. So the odds are high it wants to take it out. And then I look further left and what do I see? Further argument for why it may want to do that. This is a fair value gap. It tapped into it, I'll grant you, but it didn't really fully get the whole thing. There's still a little bit of gap there, which is why I was like, okay, I'm feeling pretty confident that we should be able to take that trade to the downside. This is how you use, I don't care if you're a scalper. I don't care if you want to start trading tick charts like me. That's fine. You're welcome to. I don't have a monopoly over that. But what I do want to say is, please, always frame your trades with the higher time frame. Always, always, always. Always. And if you don't like high time frames, you want to, I'm used to reading this as well. I don't have a problem with it. But if you prefer, okay, let's go to a range bar chart. Because that's an option too. You already know it's a bearish day. You get this first turnaround, it's not a bad idea for you to start looking for setups. Okay? Either by using the actual close, which is now the open of the new bar, or You're waiting for that pullback, in which case you wouldn't have gotten that until somewhere around here. Yeah, so that's pretty much it. Let me show you one last example for the question, what kind of trader are you? I'm all over the place today, guys. Sorry. I have this terrible pain in my neck. I'm trying to finish as quickly as I can so I can rest. So again, EU, remember we've already explained why you're only looking to take sells. So let's see what would have happened here if we got any sort of opportunity. This is a 20 pip range bar chart. I'll take us to the 1 minute and see if we have an opportunity. For those of you who don't want to trade, what is this? What I marked, remember, was a bullish candle. And I've talked about the concept of an anti-bias bar before, haven't I? I have. So what do you have here? You could wait. You see a break in market structure, the market pulls back up, and then you're trying to sell that because you saw a swing, but it failed. No problem. It's not the end of the world. The thing you would have done, though, is look to the left. Remember, ranges within ranges, swings within swings. I need you to go revisit that video. It's on my YouTube. By the time you're pulling up into here, this is a low and this is the most recent high. So you start asking yourself, what is here? What are we reaching for here? Yes, there's this fair value gap. So even if you had sold there, your stop should have been up there. What's the other thing that's there? Where does the market turn around? Look at that last bullish candle here, and look at where it comes to kiss perfectly, and then gives you that swing formation, and goodbye. And then you're exiting at the other end of the range or the halfway point to be safe. All right. I am going to now flip the camera around and we're going to talk. Yeah, there's the red eyes. Every time I finish these. So guys, I don't go through comments when I'm teaching because I don't want to be distracted. Thank you for the follow, Castian. I'm just going through old comments. Thank you for the follows. Oh, you guys are so kind. Thank you. Jace, thank you very much. I appreciate you. Castian, thanks for the follow. Let's see. Freddie, thank you so much. I appreciate you. Freddie, you're not getting out of it. Oh, Jace, thank you for the rose. You're a sweetheart. I appreciate you. Freddie. Freddie, you don't buy my kids. Let's see. New Stars, thank you for the follow. Victor Chunga, thank you for the follow. Endo the Transcendent, thank you for the follow. Galvies DFX, thank you for the follow. Freddie, thanks for explaining to them. It really doesn't matter what pair, and you don't have to win every trade. Thank you. Tule, that was not gold, but if you mean like the content is gold, thank you. User 79, I am too lazy. Thank you. Thanks for the follow. Palesa, thanks for the follow. Grace, hi. Otem Lawrence, thanks for the follow. Is that Jerry? Thank you. Is that Jerry? Some of you with your names. I just love it. I'll be back for the new comments, guys. I'm scrolling backwards and trying to see what I may have missed. FBSNG, thanks for the follow. Morris, thank you for the follow. Van Sun, hi, if you're still here. PR, thanks for the follow. Call me Lizzie Zara 7, hi, thanks for the follow. Vic Fortune, thank you for the follow. There's so many people. King Kang, thank you for the follow. I don't think you guys are all still here, though. Let me just go down to the comments. Most recent ones. Mo Dallas, I'm very glad that you learned a lot. It is my honor to teach and serve. Thank you. Lone Wolf, you're very welcome, and thank you for attending as well. It matters to me, because otherwise I'd be talking to a void. Actually, I had my second live. I think it was my second live. There was nobody there, but I kept teaching. Zero likes, zero comments, zero, nobody was there. Funny. Big Identity, you're very welcome. Jace Atkins, did you just buy market? Yes, I'm on YouTube, Jace. As I take ticks, so the same spelling of my TikTok username. Lebogang Madiba, you're very welcome. Sabio, you're going through my YouTube videos and just smiling because it was understandable. I'm very happy. That makes me so glad to hear because that's just what I want. I want to make it simple. I just want to make it simple. And I wish you could copy trade me. Tezome, first of all, I hope I'm pronouncing your name correctly. Secondly, you keep trying it. I keep telling you, we don't spoon feed here. I would be stealing from you. That's me stealing. The chance for you to learn and to get confident in the fact that you can open the chart anytime and take something. No. So you're using a tick chart as part of your trading system. Yeah, so what I have broken down for you is when I'm scalping. I sometimes, occasionally, when I know I don't have time to babysit, I will move up to higher time frames in the sense that I will, rather than use a 5 pip Renko bar, I could go to like a 25, 50 range bar charts, typically for 50s. I like that. Lately, I've been discovering how beautiful. Oh, God, I'm still heartbroken over that EuroCAD trade I missed. 200 pips. So it depends. But it's the same system. You smile more when you get to the Telegram channel. Oh, Freddie. Freddie, that's a sweet comment. Thank you. But Freddie, you still owe me signals. What's your YouTube? At I Take Ticks. David, Michael, what did you ask? I missed that. So you use the tick chart as part of your trading system. So I've explained that. I've explained that already. Tezome, you can find recorded sessions on the YouTube. It's on my bio, so just copy the link and then paste it in your browser. I don't know what TikTok did, but it seems to have deactivated the ability to open links natively in the app. So please, Castian, do I have a Telegram group? Absolutely. No, I do not send signals. Sorry. Y'all are tempting me. I should just be cruel and vicious and start selling signals. No, I won't do that. So, in case you're new here and you don't know why I keep saying I will never give signals, it is because my entire purpose here is to empower you. When I first started trading, which is about 10 years ago, I thought I wanted signals and I was taking signals. And one of the things that happened was the guy was really good. His name was Khosrow from some, I don't know where, Khosro, I don't know. He was really good. But then came a day when there were like 3 losses back to back. And because I did not quite understand, I thought I was getting scammed or something. And that was the day I realized I don't want to be spoon fed. I didn't know exactly at the time that losses were part of the game. I thought that if you're losing, you must not know what the hell you're talking about or what you're doing. But that was what did it for me that I decided I was going to learn. And also getting scammed by trying to get into some signal group. Yeah, I learned the hard way. $50. Anyway, the point is I learned that I wanted to fish for myself. And you want that too. You don't think you do, but if you're actually serious about making this a business, you want that. Because what happens if your signal provider drops dead one day or you whatever let's say it's a robot or something, it screws you over because it can happen, it does happen. Okay, just because a bot is perfectly coded and has no emotions and whatever, there is always room for that human touch, for intuition, for emotion, and for, yeah, these are things that a bot can't do for you. It's just blindly going to trade based on rules. So having said that, even if AI gets smart enough to trade your strategy, I believe in cultivating a sense of accomplishment and confidence in your abilities. So if I'm giving you signals, I'm robbing you of that. I know how good it feels to know that I can open up a chart any day and I know what I'm getting into. I know when I'm wrong, I know when I'm right. And these things are very subjective. You know, you could enter the same trade as someone else and you will lose and that person will win. There's lots of variabilities. I was literally in a group where people were catching hundreds of pips per trade, and I was still losing. And it's not that I was not bright, it's that actually I knew too much and I was greedy. So please, I adjure you, learn how to trade by yourself. Jace, all right, no problem. Telegram, copy the link. Oh my God, English. Mufasun, copy the link from my bio, put it in your browser. It is t.me/tick takers. Freddie Black, God bless you. Let me pin that. Oh, thank you so much. I said I have a Telegram group. I've answered that already. Tazome, yes, I am in Nigeria and very Nigerian. Can you come to Nigeria to meet me for what? Well, hello. Freddie, behave yourself. Freddie, sure you will not open signal business by all these people that keep asking for signals. Some guys who give signals have 15 to 100K in Telegram groups. It's tempting, isn't it? I could just take your money. Unfortunately, I cannot do that. $1,300 in minutes. Tezome, I feel like I told you this 2 lives ago. You must be careful, man. These figures you're mentioning, not everybody in this live means well. Some people are here to read those comments like that, and then they're going to come message you, probably as me or as some other person, some random, oh, I made 62,000, follow this guy. Be careful. Don't mention figures on here. Don't mention figures. Sammy, thank you. Shago, no problem. Take care now. When I get money for you, you know, see, come to Finland. I sound American. I'm very Nigerian. Well, Freddie, now you did door yourself. Oh. If you like, no start signal business. Wait, what? I didn't send any invitation. That was not on purpose. But anyway, okay, that's about it. If anybody has any other questions, go ahead and ask them now. I will be taking off in maybe 3 minutes. Thank you for being here, though. I appreciate you guys from the bottom of my heart. I don't know why, but I love to teach. It fulfills me. That's why I can, if you leave me, I could be here for hours. But I also recognize if you don't show up, I don't have anyone to teach. So thank you. But please don't just come here, listen, and think that you are now an expert. I need you to doubt me and I need you to question me. I need you to go and prove to yourself that what I'm saying is true or false. Because that's how you're going to learn and grow. Let's not fall into the trap of listening to something and thinking that, oh, now we have it. You have to go and find these things and you have to practice. And a deeper part of the practice is being at peace with losing. I know how hard it is. Forget, I actually know how hard it is to lose. I said I lost for 9 years. 9. So I'm here trying to make sure you don't have to deal with that. But there's only so much I can do if you don't put the work in yourself. I'm just here to simplify. Do you know, literally, if all you did was just you just pick one pair that moves a fair deal, like maybe GBP CAD or something, GBP something, and you just pick one Renko bar chart, maybe 25 pips, and then one regular time frame chart, maybe a 5 minute. If you just stuck with that, and then you pick one thing, are you looking for a retracement into the range, or are you waiting for the money to come out of the range? You notice most of my examples, I'm always favoring sells. That's because I just love to sell. But if you can do that, if that's all you did, You see, you don't need signals. You see, what I've been trying to tell you is that you don't even have to win every trade. There's this exercise I've said, do it. I want to believe good gurus and mentors. I don't see myself that way. Y'all call me that way. That's great. But is this exercise where grab a coin. You don't even need a coin. There's an app. There's a coin flipping app, and just make the heads. Each time you flip it and you get heads, let it be that you've won. So let's say it's a trade where you have a 1 to 3 risk reward ratio, right? Let's say you've won that trade, and then each time you flip it and you get tails, and let's say you've lost. Do that for 100 times. Just flip the coin 100 times, get a piece of paper. Each time you win, you write +3. Each time you lose, -1. And then you'll see for yourself. You don't need to win every trade. You don't measure good trading from just one trade, from just 5 trades. No, you don't measure good trading in just 1 week. These prop firms, man, fuck them, honestly. Like, yeah, it's nice. They offer you capital that you wouldn't have otherwise. But I cannot stand the shady psychological trick they pull on people when they say, oh, yeah, passing as few as 3 days. But in your contracts there, where people, they know a lot of people don't read, they will be telling you, oh, take your time. Fuck that. It's very annoying. It's painful. It's painful, and it makes it very obvious what they're trying to do is just make money off of you. So you don't have to rush. Some of you, and I'm not judging you, I'm saying this because I used to be like that too, have very unrealistic time frames. You want a Lambo in 2 months. Go and do G now. You want a Lambo tomorrow. Monawao. When it comes to everything in life, not just trading, I like to put things in blocks of time. I like 30-day experiments, 60-day experiments, 90-day experiments, quarterly experiments. Don't rush. Don't rush. It's on Tinder, a girl from Asia. You talked on WhatsApp. She found out she was a scammer and wanted your money. Yeah, so yeah, that's a pig butchering scam. And they also have very realistic platform that looks like your money's growing. It's not. Anyway, Modalis, I do this every Monday through Friday. I'll be honest with you guys, there's a part of me that kind of wants to just stop and I'm creating the book. There's a part of me that wants to stop briefly. I don't know if it's I need a break or what, but I don't think it's that I need to stop. I think it's that I need to find a way to help you even better. I think that's what it is. But I'm confused right now about how much more I could do. Well, Dallas, it was not beans. Oh my God, 9 years of stress. I almost wouldn't. I wouldn't have been here. Let's just put it that way. You can buy Lambo and still not buying it. Tezome. I don't know if I'm even pronouncing your name correctly, first of all. My dude, that's not the place to be flexing your riches. Again, in these 55 people, there's probably a few G boys here plotting your matter. I beg, oh, I'm begging you. Exactly, Freddie. No too much, get confused on chart. No little able to identify that specific thing you're looking for. Boom, that's it. That's it. Just pick one thing and you see it over and over again. Okay, guys. That's about it. Let them come. So I don't feel bad for you anymore because very clearly you're the one who you like trouble. New starts. Hi, good night. I need help as well. You're dying for some help. Well, keep coming to the lives. And if you are new, you know what to do. Go to that baby pip site I keep talking about. Make me laugh this guy. There's so many people are plotting your matter. I don't even know. I don't know these people individually, but I can feel it. I can feel it. They're coming for you. Do you get? You should do a giveaway Oh my god. Men don't do no way. Show me that I say men don't do reason them already. Ain't no way. Ain't no way. Sammy the Great, thank you, bro. I see you. All right, guys. It's been fun. It's been really fun. It's been nice. So trade well. May the markets be with you, favor you. May the pips be in your favor as well. Don't do stupid shit. And if you blow your account tomorrow, it's not the end of the world. Don't blow your account. Good children. But yeah, now. I'll see you guys next time. Be good. Be well. Good night.